In September, we talked about cautious optimism returning to the market, inflation easing slightly, lenders softening a little, and a slow return of confidence. Fast forward to October and things haven't gone backwards, but they haven't made dramatic leaps forward either. Inflation's still hanging around, the base rate hasn't moved, and the housing market is largely flat. But flat isn't bad. In fact, in a volatile market, flat often signals stability. At the same time, we've seen business closures, unemployment edging up, and progress on the Renters' Right Bill. Let's break it all down and see what October has really meant for investors, business owners, and the UK economy. Inflation continues to sit at around about 3.8% year on year. That's well below the double-digit highs we saw in 2022 and 2023, but it's still significantly above the Bank of England's 2% target. Prices aren't falling, they're just rising more slowly, although I'm sure you feel as though prices are doubling every time you do your weekly shop. Even wages are creeping up in normal terms, but don't get too excited just yet. Once you factor in rising living costs and the potential for extra taxes in the November budget, what seems like a pay increase often ends up feeling smaller in real terms than it did a year ago. For households, that means budgets remain tight, and for property investors, it's a reminder that rental affordability depends on real disposable income, not just the figure printed on a payslip. The base rate has remained at 4% throughout October, as expected, since the Monetary Policy Committee hasn't met this month. Lenders, however, continue to adapt to the current environment. Swap rates, which largely determine the cost of fixed mortgages, have edged down slightly since September, prompting small adjustments in mortgage products. These aren't game-changing reductions, but they show that lenders are cautiously responding to the market signals. For investors, the reality is that most buy-to-let mortgages still sit in the 5 to 6% range. Lenders are tightening criteria, favouring applicants with strong rental coverage, experience, and a clear deal structure. As we discussed in the September update, it's no longer purely about how much you can borrow. It's about presenting a well-prepared, realistic plan that shows the lender the value and security of the investment. The labour market is showing some subtle signs of cooling. Unemployment has edged up to around 4.8%, and job vacancies are slowly falling. Sectors like hospitality, retail, and manufacturing are seeing job losses, which isn't surprising given the state of the economy and the fact that large stores and well-known restaurant chains seem to be closing their doors across the country almost every week. Wage growth remains positive, but the benefit is muted. With prices rising and potential tax increases on the horizon, what appears as a higher salary often has less purchasing power than it did a year ago. For tenants and property investors, this is critical. Rental demand depends on real disposable income. Areas anchored by hospitals, universities, and logistic hubs are still performing well for rentals, but investors need to be mindful of broader household cost pressures. And there's another challenge. Landlords are facing higher regulatory and compliance costs. Inevitably, some of these costs get passed on to the tenants in the form of higher rents. But there's a limit to how far this can go before tenants struggle to afford rent, forcing landlords to absorb losses, a situation that could create a perfect storm of vacant properties and distressed sellers. October brought more high-profile business closures, most notably Pizza Hut's UK dining operations entering administration. Over 60 restaurants are shutting, putting more than 1,000 jobs at risk. Rising costs, reduced discretionary spending, and pressure on margins are affecting not just restaurants, but retailers and service businesses across the country. In September, we spoke about how Amazon announced that they would be closing all of their Amazon grocery stores in the UK. And now in October, more news from Amazon as they announced plans to cut around 14,000 corporate jobs globally as part of a major restructuring and cost reduction drive. The company cited rising operational costs, the rapid integration of artificial intelligence, and a broader effort to streamline its structure as the main reasons behind the decision. According to senior leadership, the move is aimed at removing layers of management and reallocating resources towards AI development, logistics efficiency, and automation, areas Amazon sees as critical for long-term growth and competitiveness. While the company has not yet confirmed how many of the affected roles are UK-based, the cuts are expected to impact staff across several corporate divisions, including operations, human resources, and tech development. Amazon remains one of the UK's largest private employers, meaning any reduction in its headcount has wider implications. More broadly, Amazon's move reinforces a trend we've seen developing since early 2024. Global tech firms shifting focus from aggressive expansion to leaner, AI-driven operations. That pivot may be good for long-term productivity, but in the short term, it creates uncertainty across both the employment and property sectors. And Amazon wasn't the only major name making headlines. Nestlé also confirmed plans to cut approximately 16,000 jobs worldwide as part of its broad restructuring effort aimed at streamlining operations and improving profitability. The company cited persistent cost pressures and changing consumer behaviour as reasons for the move. Closer to home, Paddy Power, part of the Flutter Entertainment Group, announced the closure of 57 betting shops across the UK and Ireland. Around 247 UK jobs are now at risk. The closures are another reminder that physical retail and leisure businesses continue to face mounting challenges from rising energy costs, reduced footfall, and the growing shift to online platforms. And what we're seeing here is a sharp reminder that no job, no matter how secure it may seem, is truly guaranteed. When global giants like Amazon and Nestlé begin large-scale restructuring, it sends a clear message. Stability is changing. Just like when UK car manufacturing moved overseas and jobs were lost, we're now seeing a similar shift. But this time, it's not about moving operations to another country. It's about moving towards AI and automation. These changes don't just affect individual employees. They ripple through local economies, reduce spending power, influence rental demand, and reshape entire industries. That's why it's more important than ever not to rely on a single source of income. Whether through business, property, or other investments, having multiple streams of income is not just smart, it's essential. Even the largest companies in the world can change direction overnight, and those who aren't prepared will feel the impact first. The housing market in October has been broadly steady. Nationwide reported small monthly price increases, while Halifax and Rightmove showed only marginal regional variations. Average UK house prices remain in the high 200,000 range, consistent with the levels seen since the start of the year. Sentiment has improved compared to early 2025 when buyers and lenders were more cautious. Confidence is returning, but transactions remain below pre-pandemic averages. Regional differences are important. Northern and Midland cities are seeing modest growth, while parts of the south remain subdued. For investors, the environment rewards careful, balanced buying. Sellers are more realistic, rental demand remains strong, and steady income is achievable even if capital growth is limited. Rental demand continues to exceed supply in many regions, particularly in university towns, commuter belts, and employment hubs. Annual rent growth is slowing slightly but remains above wage growth in several areas. And at the same time, landlords face rising regulatory and compliance requirements under the Renters' Right Bill. Professional investors can adapt to these changes, but hobbyists or casual landlords may struggle with documentation and ongoing obligations, leaving room for structured investors to capture the more stable, long-term rental income opportunities. However, there's a balance to strike here. Rents can only rise so far before tenants struggle to pay. Combined with rising costs for landlords, this could create a scenario where cash flow pressures affect both sides of the market. Savvy investors will need to monitor affordability and plan contingencies to protect themselves from potential vacancies or distressed tenants. Heading into the winter months, several risks persist from September. Inflation could spike if energy or wage pressures surge. The Bank of England may maintain higher for longer interest rates, keeping borrowing expensive. Unemployment could rise further, and the upcoming autumn budget could introduce new taxes or policy changes for households, landlords, or businesses. Investors should prioritise liquidity, maintain conservative leverage, and have robust contingency plans in place. Flexibility will be key if economic conditions tighten further, but at the same time, opportunities remain. Rental demand is strong in areas anchored by universities, hospitals, and logistics hubs. Motivated sellers are appearing in both residential and commercial markets, often under refinancing or operational pressure. Investors with ready cash or flexible funding can negotiate favourable deals even in a flat or steady market. The key is to focus on areas where demand is consistent and long-lasting, maintain financial discipline, and move decisively when opportunities arise. If you're a landlord or property investor, now is the time to get proactive. Review upcoming mortgage expiries and talk to lenders early. Update tenancy agreements and ensure compliance documentation is current, particularly with the Renters' Right Bill coming into effect. Monitor local employment trends and new developments that could affect rental demand. Cash flow, compliance, and flexibility will define who thrives in 2026. Those who plan ahead, stay professional, and stress test their portfolios will be better positioned to navigate uncertainty and capitalise on opportunity. So that wraps up the October 2025 UK economy and property update. In November, we'll take a closer look at early winter data, interest rate trends, and whether the market is setting up for a slowdown or a spring resurgence. We'll also review the outcome of the autumn budget and what it means for investors and business owners, as well as the results of the November Monetary Policy Committee meeting. On top of that, we'll cover all other key news from the month that could affect your future decisions, helping you stay ahead in both property and business planning. But for now, thank you very much for watching. I appreciate you for being a subscriber, and I'll see you again on the next one.